Gosh, I've got monetary vandalism to share with you. It's getting bad out there, and related to that are 10% mortgage rates on the horizon and why inflation is just going to get worse and worse. Settle in, you'll want to watch the entire video here. Hi, I'm Keith Weinhold, Get Rich Education founder, Forbes Real Estate Council member, and longtime real estate investor. Yeah, you're seeing fewer of those "we did a thing" posts from your high school and college acquaintances holding up shiny new house keys. With housing affordability just down in the dumps, more and more people will become renters. So, by the way, if you can afford entry-level property that you rent to others, there's the opportunity. That way you can expect to be well positioned regardless of what's coming. All right, so among those things coming, what about those 10% mortgage rates? I mean, no one truly knows, but look, the Fed, they have kept rates unchanged for 4 straight months, but here's how things could get worse and how rates could spike again. It's if there are more glowingly good reports about the economy. Yeah, whenever you get a hot GDP report like the one we just had, the gross domestic product, which means the total value of all of our economy's produced goods and services, as it was up nearly 5% year over year. Well, something like that. First, that adds insult to injury for all those wrongly predicting a recession and a housing crash for almost 2 years now. I think that those doom and gloom forecasts, they keep going worse than Elon Musk's X takeover, formerly known as Twitter. I mean, sheesh, could we just get the recession over with so that people will stop talking about it? But getting back to the glowing GDP report, we saw what's really going on out there. It showed that consumer discretionary spending was way up on categories like travel, sports events, and even gambling. So yeah, your tenant can afford the rent and they're employed. But numbers could be less pretty for future quarters because student loan payments have resumed after a long pause. All right, well, how many dollars is that going to take out of the productive economy? Although I think 10% mortgage rates appear unlikely in this cycle, one reason that interest rates could spike again is to combat ongoing inflation pressures. Well, a hot GDP report shows us that inflation pressures are very much evident. Oh yeah, they're still there. And actually, it's rather paradoxical that good news, like a hot GDP report, can stoke fears of bad news, like higher inflation and even more rate increases. Organized labor, from UPS workers to Hollywood writers and actors, they all have big wins. And no matter what side you're on, unions or non-union, it really doesn't matter. All these higher wages that result from union wins, they will get passed along to you, the consumer. For example, the United Auto Workers' new deal with the big 3 automakers, that includes that Ford assembly line workers can make $40 an hour by the end of their contract. So yeah, you're going to be paying even more for cars and groceries and everything in between. And then there are multiple wars now. And wars typically create higher oil prices, which trickles and permeates in to everything. The US funding packages alone for Ukraine and Israel, well, they're costly too. Whether you agree with them or not, you and I are both paying for them. And when they print more dollars to pay for all that stuff, then all the dollars that you're currently holding on to, whether that's in savings accounts or 401k or stocks or even your real estate equity, all of that diluted you yet again. Super savers will inevitably trend toward poverty, but this dollar devaluation gets applied to your debt, so the debtors will keep winning. And in high inflation, of course, the opportunity cost of idle saved dollars gets steep. And what it is the result of more monetary vandalism. I'll describe that shortly, but let me show you what I mean. Last weekend, things got, I guess, rather empirical for me. I paid $7.49 for a single 9-ounce can of La Colombe Triple Latte at Seattle Airport, just like this one. one. It was $6.80 plus 10.1% sales tax. And oh, I was also afforded the opportunity to leave a tip simply for being handed this canned coffee. Yes, we're nearly then at $1 an ounce for canned coffee now. There is tipflation on top of inflation. I mean, I almost opted for a drink from the water fountain instead. Maybe I should have. You know, actually, you could be upset at me or people that make an act like that, because the more people that pay this, the more likely they are to charge that price or higher in the future. And yeah, anymore, why merely settle for overpriced when you can do wildly overpriced? I suppose that's where we are. And you need to understand that these prices are not coming back down. I mean, when does that ever happen? They're permanently higher, and they will just keep trending and spiraling ever higher. Let's look at the history. History over hunches. In fact, here's the annual inflation rate from years past, going back to 1990. It was 8% last year. It won't be that high this year. But look, you can see that in 2009, it took the worst global financial crisis of your lifetime just for prices to pull back less than 0.5%. A Big Mac combo costs as much as $18 at one Connecticut McDonald's location. Next year, California is going to increase its minimum wage for fast food workers to $20 an hour, and inflation continues in our real estate world too. Both Freddie Mac and Black Knight show the same 0.7% monthly increase in home values each for June, July, and August. That's 8.4% annualized. You know, one place though where inflation has cooled is with rents. Annually, single-family rent growth is up 3%, multifamily's up just 1.5%. Well, with low home buyer affordability, meaning more renters, will your tenant really be able to afford higher rent next year? Historically, the answer is yes. Rents are remarkably resilient, recession or not. And there's another good sign. For the 5th month in a row, wage growth has outpaced inflation. But yeah, you're going to continue to see this monetary vandalism. When more dollars get created, which is what inflation is, every single dollar that you hold gets diluted again. Yep, it just is going to keep vandalizing your prosperity. And let's look at that. Here's the definition of vandalism. It's deliberate destruction or damage to public or private property. Yep, the more of your prosperity that you hold in dollars, the more that you will be damaged by your government. Look, the number of self-serve kiosks where you interface with a screen, that seems to be going parabolic. And you've got to recognize that that's inflation too. That is service inflation, skimpflation. They're skimping on services. They've outsourced it to you. You've got to do it yourself now. And it's not just like the self-checkout at supermarkets anymore. At a hotel, I recently used a screen to check myself in. And at the airport, it's now to print all of the bag tags yourself, even the little barcode that goes right on your luggage. I mean, this is all being normalized right now. So how do you protect yourself from vandalism? Well, gold is a long-term hedge against it. I showed you in another video how since 1975, real estate prices have 10x'd in dollars from about $40K to $400K for the median home, but instead it took just 223 ounces of gold to buy the median home in 1975 and only 216 ounces today. That's exemplary of what gold can do for you, but income producing real estate is better than a mere hedge like gold, like I've stated elsewhere on this channel. This real estate is not just an inflation hedge, it's an inflation profiting vehicle. It's sort of like graffiti removal and more for the monetary vandalism that's inevitably going to take place if you don't protect yourself from this surreptitious and constantly pervasive vandal known as inflation. So the short story is to hold real assets to protect yourself from this ongoing monetary vandalism. And hey, in the comments, let me know if you have an inflation story wilder than mine for $7.50 canned coffee, maybe a more expensive item. I'd love to see your comment. I'm Keith Weinhold. I'll see you in the next video. You can watch this one next.